Now, I'm not going to pore over every ratio because they're well described in the book and they're pretty well described in the slides as well. But I will pause on some of the ones that are very interesting. This one, for example, is extremely intuitive. The calculation's a bit wonky, and what you do is you take your normal operating expenses. Those are things like payroll, utilities, insurance, things like that. And then you take out depreciation because depreciation, sorry, this gets techie. Take out depreciation because it's a non-cash expense. So basically you're looking at your cash expenses. And then you divide that by 365 because what that does is that gives me daily cash expenses. One way to think about this, now you might have heard the expression, is your burn rate. In other words, how much money are you burning through each day? Like if you look at your household budget, you know how much you might know how much you spend in a month, and then you just divide that by 30 and you get your daily burn rate. In other words, you know you're spending X much dollars per day on expenses. Now that I know my daily burn rate, I divide my cash, money in the bank, by that burn rate, and that tells me number of days cash on hand. And what that means is how many days can I go if the cash coming in stops? Now, one of the alarming things about American savings rates, or the lack thereof, is that the average family in the U.S., this days cash on hand is under 2 months. Another way to look at that is that the average family is less than 2 months from homelessness. In other words, if they got laid off and lost their job and that money in stopped all of a sudden, they only have enough cash to cover 2 months of living expenses. Now, in terms of what you want, generally you want that to be increasing and not decreasing. You want to have more days of cash on hand because it means you can last longer if you get laid off or if something bad happens to your business. And comparing yourself to peers, you want to be above the median again. Just a reminder on the general class of asset turnover ratios. As I said earlier, that's kind of efficiency. How well do I convert resources? In other words, all the money I've invested in having a big hospital, how well am I converting that into revenue? Now, looking at your leverage ratios, and the slide even notes that your leverage and your coverage ratios are kind of related. Leverage says more about how you're using your debt, and coverage says more about your ability to repay that debt. In that regard, if you were a bank giving a loan, you would be much more interested in these coverage ratios because that tells you as a bank whether you're going to get repaid or not. Now, every now and then there's not magic numbers, but at least rules of thumb. This is one of them. This is debt to assets. Now, the calculation's pretty simple. This is just total assets, everything you have. Cash, short-term stuff, and your equipment, your buildings and everything, your long-term stuff. Your total worth, basically, all your assets, and then you compare that to the debt. Generally, you want that to be about 0.5 or below, which means you're funding at most half of your stuff with debt. But again, that's a rule of thumb. When you do compare yourself to peers, you definitely want to be below your peers for this measure. Times interest earned is another interesting one. The computation is definitely wonky, so I'll let you look at the textbook for that. But the interpretation is pretty simple. How many times over do you cover it? Once, twice, 3 times? How many times do you cover your bare minimum interest payments? You can think of this as how many times over do you cover your credit card minimum. So that rule of thumb right there is you always want to be at least 1. You want to be able to keep up with the minimums. So you need to be at least 1 there. You want to be increasing, and generally to look like a worthy credit risk, you want that to be above the median. In other words, you want to be better than your peers. Now, your profitability ratios are what you expect now, but in not-for-profit land, sometimes they call it operating margin. One of the hinky things about working in not-for-profit land is that you want to limit your quote-unquote your profit to no more than, let's say, 5 to 7%. If you start making more than that, even if you call it margin, everyone knows it's profit. And if you start making more than that, it starts to look like you're not a not-for-profit. If you're a hospital, people might be saying, how come you're not spending more of those profits helping people in poor communities or writing off debt for people who you keep billing? Now, the last general class of ratios is called program expenses. And this has a lot to do with, let's say, public health programs right there, where you'll want to add up all actual programs. So let's say if you run a public health agency, you look at all the programs that are actually going out there and helping people, and you total up all those expenses, and then you divide that by total expenses. Because remember, total expenses will include other things like your overhead, your admin, things like that. So this is a way of saying, now if you had nothing in admin, no expenses in admin, then your total expenses would be your program expenses, and this would be 1. But the more that you do spend in admin, the lower this ratio is going to be. The reason that's important is if you are a not-for-profit, it gets suspect when you're spending too much in admin and not enough in the actual services that people are most interested in. Now, turning back to the assignment, let's see where we already kind of answered that one about the audit and who takes the responsibility. We looked at all those different types of ratio analysis.